First requirement is calculate the weighted average cost of capital of the fence company. There is no need of doing ungearing, regearing in the first part. Part B, calculate a cost of equity which could be used in appraising the new project. There must be gearing and gearing in the second part. Explain the difference between systematic, unsystematic risk in relation to the portfolio and the capital asset pricing model. So equity beta of the fence company is 0.9 and the company has issued 10 million ordinary shares. Market value of each company share is $7.5. Company is also financed by 7% bond with a nominal value of 100, which will be redeemed in 7 years' time at a nominal value. Bonds have a total nominal value of 14 million. Instead of giving in the balance sheet, the examiner has just given data in the paragraph form. Interest on the bond has just been paid and the current market value of each bond is 107.14. French company plans to invest in a project which is different to its existing business and has identified a company in the same business area as the project, Hexco. Equity beta of the Hexco is 1.2 and the company has an equity market value of this, market value of debt is this. Risk-free rate is given, average return on the stock market is given, tax rate is given. So let's solve the part A. We will solve the cost of equity first. Risk-free rate is given. That is 4%. Beta is given, current beta 0.9. And return of stock market is given. And that is 11%. So cost of equity is risk-free rate plus beta into bracket start RM minus RF. So that is 10.3%. 10.3%. Okay. Then cost of debt. It's a 7 years bond. Nominal value is given, interest is given, and redemption value is given. So you can solve in two ways, either using the annuity factor or by putting all the years in this way. 7. Market value, put the market value as a negative number, 107.4. And every year you will write the interest after tax. What is the interest rate? 7% bond. And its after tax value is, tax rate is 20%, after tax value is 5.6. Plus, if nothing is mentioned, this bond will be redeemable at par. Okay. Redeem in 7 years at value at nominal value. Now calculate its KD using the IRR method. You can also solve this using the typical annuity factor approach. So we have calculated stock market cost of equity. We have calculated KD. Now let's calculate the WACC. Let me write the market values. Okay. Equity number of shares are given 10 million. Into 7.5 is the market value per share. Debt book value is given 14 million. Par value is 100. And market value is 107.14. Okay. Cost is given. We have already calculated the cost of equity. 10.3. KD is this. Multiply these two. take the total. Take the total of this and calculate the WACC. This is WACC. Okay. That is WACC. Now let's do the part B. In part B, remember, identify the proxy company, first step, because we are solving cost of equity of a new project. Cost of equity of new project. Okay. First step, identify the proxy company. Hexco, it is assumed that Hexco is a suitable proxy company. It is written Hex company. Second step, ungear the beta of Hex company. Okay. What is the beta of Hex company? Beta of Hex company is 1.2. And its equity value is 54 million. And that is 12, 54 and 12. So what is the beta asset? Beta equity into equity value divided by equity plus debt into 1 minus t, that is 0.8. This is a beta asset. Now regear this beta using fence company gearing. And we have already calculated the fence company gearing above. Write that. Now let's calculate the beta equity. When you have beta asset, you will multiply equity plus debt into 1 minus t divided by equity. This is beta equity. Okay, risk-free rate is also given above. Return of market is also given. Simply calculate the new cost of equity. Risk adjusted cost of equity. And that is risk-free rate plus beta into RM minus RF. Cost of equity. Okay. That's how you will calculate it. Last part is difference between systematic and unsystematic risk. You will explain that there are two types of risk which you can face whenever you are investing in stock market. One is systematic risk. Systematic risk is the risk related to the economy overall. It covers the market-wide risk. For example, interest rate, exchange rate, political risk. So systematic risk cannot be diversified away if you invest in different companies. This is the risk which investor has to face at any cost. If you invest in any company, you have to face the systematic risk. It can be higher or lower depending on the nature of the company, but systematic risk is there. Unsystematic risk is the risk related to the individual factors of a particular company. It is specific to each company. For example, the key employee left the company. For example, the employee went on the strike. That are the unsystematic risk. You can diversify the unsystematic risk by investing in different companies by making a portfolio. So unsystematic risk can be diversified away. Systematic risk cannot be diversified away. So the CAPM, capital asset pricing model, assumes that investors are rational, unsystematic risk will be diversified away. but systematic risk will be there. So CAPM return assumes only the systematic risk. It does not assume the unsystematic risk. It assumes that investors are rational and they will reduce the unsystematic risk.